Bitcoin is fraud, worse than tulip bulbs. September 2017, Jamie Dimon said that on stage at a banking conference. CEO of JPMorgan, the biggest bank in America, $3.9 trillion in assets. He said Bitcoin would get someone killed. He threatened to fire any employee who traded it. That was 8 years ago. November 6, 2025, CC filing drops, Form 13F public record. Every institution has to file it every 90 days. One line buried in the document. JPMorgan Chase, 5.28 million shares of BlackRock Bitcoin ETF, $343 million, up 64% in 90 days. The same bank whose CEO called Bitcoin fraud now owns more than $300 million of it. They increased their position while Bitcoin dropped 20% from all-time highs. They bought when everyone else panicked. They bought when the headlines screamed crash. Today you'll see the documents, the numbers, the option strategies they're using, the 3 scenarios playing out right now, and why this changes everything for your money. Let's go. What actually happened? June 2025. JPMorgan holds Bitcoin exposure worth $210 million through BlackRock's IBIT ETF. September 30th, $343 million. That's a jump of $133 million in one summer. 64% growth in 90 days. But here's where it gets interesting. They didn't just buy shares, they hedged like professionals. The SEC filing shows $68 million in call options. That's a bet on price going up. $133 million in put options. That's insurance against it going down. Wait, why double the insurance compared to the upside bet? Think about it like this. You buy a house for $1 million. You insure it for $2 million. Does that mean you think it'll burn down? No, it means you believe the value will rise, but you're protecting against any scenario. JPMorgan did exactly that. 68 million says we think Bitcoin climbs. 133 million says we're ready for anything. This is how Wall Street plays, not gambling. Calculated risk with downside protection. Now why does this matter? Why should you care that one bank bought an ETF? 3 reasons. First, JPMorgan is not just any bank. $4 trillion in assets. When they move capital markets, watch. This is the institution that sets trends for pension funds, hedge funds, family offices. If JPMorgan allocates to Bitcoin ETFs, others follow. It's herd behavior at the institutional level. Second, timing. They bought when Bitcoin fell from $126,000 to $100,000, down 20% from the peak. Institutions don't buy euphoria. They buy fear. They buy dips. You know who bought at all-time highs? Retail. You know who's buying now during the pullback? The smart money. Third, they're not alone. Look at the bigger picture. Goldman Sachs holds 30.8 million shares of IBIT. That's 6 times more than JPMorgan. 906 institutional investors filed 13F forms in Q3 showing Bitcoin ETF positions. Harvard University. Yes, that Harvard. The one where professors teach that Bitcoin is a speculative bubble. Their endowment holds Bitcoin ETF alongside Gold's PDR. You see the irony? The institutions telling you to stay away are quietly accumulating. This isn't one trade, this is a movement. Here's what JPMorgan's own analysts are saying. Nikolaos Panagiotsoglu, chief strategist, November 2025 report, quote, Bitcoin is trading at a discount to gold when adjusted for volatility, end quote. Let me translate. Gold hit $4,000 per ounce recently, but gold's volatility increased, Bitcoin's volatility dropped. When you adjust both for risk, Bitcoin should be valued higher relative to gold than it is right now. The math? To reach parity with gold's private sector investment on a risk-adjusted basis, Bitcoin needs to hit $170,000. That's 67% above current levels. JPMorgan's target, $170,000 within 6 to 12 months. Let that sink in. The bank, publicly skeptical of Bitcoin, has internal analysts projecting nearly a 2x move in under a year. Who do you trust? The CEO's public comments or the $343 million position backed by research calling for 70% upside? Actions matter more than words, always. Alright, let's zoom out. What's happening across the entire institutional landscape right now? Q3 2025 was the quarter institutions went all in. Not just JPMorgan, not just Goldman. This was widespread. BlackRock's IBIT crossed $100 billion in assets under management. That's the fastest any ETF in history reached that milestone. 61.4% market share of all Bitcoin ETFs combined. It beat Fidelity's FBTC at $30 billion. It crushed Grayscale GBTC at $23 billion. IBIT became BlackRock's most profitable product, more profitable than their flagship S&P 500 fund. Larry Fink, BlackRock CEO, called Bitcoin an index of money laundering in 2017. 2025, he launched the most successful Bitcoin product ever created. Another case of say one thing, do another. Institutional holdings in Bitcoin ETFs grew 12% to 7 million BTC by mid-November. 61% of surveyed institutional investors said they plan to increase allocation in 2025. Not decrease, increase. These are pension funds managing teacher retirement money, endowments funding universities, sovereign wealth funds. They're not buying Pokemon cards. They're buying an asset they believe will appreciate long term. Why the sudden shift? 2 reasons: regulation and infrastructure. March 2025. The Office of the Comptroller of the Currency gave national banks permission to hold crypto deposits as reserves. That was a green light institutions waited years for. July 2025, Digital Asset Clarity Act passed. It removed the regulatory gray zone around crypto classification. Banks could finally operate without fear of retroactive enforcement. The legal framework matured. Then infrastructure, ETF ETFs solved the custody problem. Banks don't want to manage private keys. They don't want the operational risk of holding Bitcoin directly. ETFs give them exposure through a regulated vehicle traded like stocks, daily liquidity, transparent reporting, familiar tax treatment. It's the bridge between traditional finance and crypto. JPMorgan and every other institution waited for this bridge to be built. Now it's here, and they're walking across it with billions. But wait, there's more. This isn't just about buying an ETF and holding it. JPMorgan is preparing to integrate Bitcoin into their lending operations. By the end of 2025, the bank plans to accept Bitcoin ETFs as collateral for loans to institutional clients. Here's how it works. A hedge fund holds 100 million in IBIT shares. They go to JPMorgan, they pledge those shares as collateral, they get a loan for 70 to 80 million in cash. The Bitcoin stays in their portfolio, they keep the upside exposure, but now they have liquidity to deploy elsewhere. Leverage without selling, this changes everything. Bitcoin officially becomes capital, just like stocks, just like bonds, just like real estate. You can borrow against it within the traditional banking system. That means institutions can use Bitcoin for more than just appreciation. They can use it as productive capital in their balance sheet strategies. This is irreversible integration. Once Bitcoin is accepted as collateral by the largest bank in America, there's no going back. The genie is out of the bottle. Alright, let's be honest. What if JPMorgan is wrong? What if this whole move blows up in their face? Bitcoin dropped from 126,000 to 100,000 in a month. That's a 20% drawdown. The Coinbase Premium Indicator, which measures US buying demand, showed the worst stretch since April. The Federal Reserve turned more hawkish on interest rates. Fewer rate cuts mean less liquidity flooding into risk assets. $2.4 billion flowed out of crypto ETFs recently. Somebody is selling, big money is taking profits. So the question becomes, what if the sellers know something we don't? What if institutional buying is a trap? Maybe. History offers a clue. 2022, Bitcoin crashes to 15,000. Everyone screams it's over. Institutions pull out. Retail capitulates. Then what happened? 7x rally to 105,000. The people who sold at 15,000 in fear missed generational wealth creation. The people who bought at 15,000 became rich. JPMorgan isn't playing a 3-month game. They're playing a 3 to 5 year game. For them, a dip to 70,000 or even 60,000 isn't disaster. It's an opportunity to add more at lower prices. Institutions think in decades. Retail thinks in days. That's the difference. What does this mean for you? 3 possible paths forward. First path, institutional buying continues. Regulators stay friendly. The Fed starts cutting rates in the second half of 2025. Bitcoin climbs toward 150 to 170,000 by end of 2026. What do? Dollar cost average, every week, every paycheck, 70 to 80% of your crypto allocation in Bitcoin. Hold for 2 to 3 years minimum. Don't try to time tops and bottoms, just accumulate. Second path. The Fed holds rates higher for longer than expected. Institutions lock in profits. Bitcoin enters a prolonged sideways range. 90,000 to 120,000 for the rest of 2025. Possible test of 70 to 75,000 support. What do? Buy the dips at 75 to 80,000. Hold 20 to 30% in stablecoins for flexibility. Be patient. Boring markets reward discipline. Third path. Macro crisis, recession. Bitcoin breaks below 70,000. Panic selling. Price drops toward 50 to 60,000. What do? Set stop losses at 78 to 82,000. Move to stablecoins. Wait for capitulation. Then buy heavily at the bottom. Remember 2022. 15,000 was the bottom. People who bought there made 7x. Which path happens? I don't know. Nobody does, but now you're prepared for all 3. What should you do right now? 3 things. 1. Watch the 13F filings every quarter. They're public documents. You can see exactly what JPMorgan, Goldman, and BlackRock are buying. Next filing deadline is February 15th, 2026. Mark your calendar. 2. Use fear as a signal. The fear and greed index is at 24 right now. Extreme fear. Historically, when this drops below 25, the next 6 months produce 40 to 60% gains. Fear is when smart money buys. 3. Stop listening to what people say. Watch what they do. Jamie Dimon can say whatever he wants on TV, but his bank put 343 million into Bitcoin. Actions reveal truth. Words create noise. Always follow the money. Let me bring this full circle. JPMorgan increased their Bitcoin ETF position by 64% to 343 million in 90 days. Their analysts project $170,000 within a year. The bank is preparing to accept Bitcoin as loan collateral by year-end. 906 institutions are already in. 61% plan to increase exposure. This is not hype. This is quiet institutional accumulation. While retail reads headlines saying Bitcoin is dead 2017, Diamond screams fraud, Bitcoin was $4,000 2025, 104,000, 26x return. The people who listened to his words missed out. The people who watched institutional actions made fortunes. Now you know where to look. JPMorgan made their choice. $343 million is not an accident. The question is, have you made yours? Subscribe to this channel so every quarter I break down the new 13F filings and show you where the smart money is really moving. Next video drops in 3 days. Cathie Wood cut her Bitcoin price target from 1.5 million to 1.2 million, but her ARK funds are still buying. Why? I'll show you the data. See you then. Let me show you something most people missed in those SEC filings. The options strategy tells a deeper story. JPMorgan bought call options worth 68 million, put options worth 133 53 million, that 2-to-1 ratio, it reveals their actual thesis. Wall Street uses options for two reasons: speculation or hedging. When you hedge a long position, you buy puts to protect downside. The size of your hedge depends on how much volatility you expect. JPMorgan hedged at a 2x ratio. That means they're pricing in significant short-term volatility but maintaining long-term conviction. Here's the translation. They expect Bitcoin could swing 20 to 30% in either direction over the next 6 months, but they're staying in the position regardless. The puts aren't an exit strategy. They're insurance while they ride out turbulence. This is critical. If JPMorgan thought Bitcoin was going to crash, they would have sold the shares entirely. They didn't. They added to the position and bought insurance. That's the behavior of someone who believes in the asset but respects the volatility. Professional risk management, not fear. Now let's talk about who else is buying and why that matters. Goldman Sachs holds 30.8 million shares of IBIT, 6 times JPMorgan's position. But here's what nobody talks about. Goldman was actively hostile to Bitcoin for years. Lloyd Blankfein, former CEO, called it a vehicle for fraud in 2017. Fast forward to today. Goldman's private wealth division offers Bitcoin to clients with minimums of $10 million. Their trading desk handles Bitcoin derivatives. They underwrote Coinbase's IPO. They're not just buying ETFs, they're building an entire crypto infrastructure inside the firm. Why the reversal? Client demand. High net worth individuals demanded crypto access. When billionaires want something, Goldman provides it. Period. Their massive IBIT position isn't a directional bet. It's inventory to serve client orders. That's actually more bullish than a speculative purchase. It means sustained organic demand from the wealthiest people on the planet. Morgan Stanley, another major player. They allow their 16,000 financial advisors to offer Bitcoin ETFs to qualified clients. Think about the implications. Morgan Stanley manages 4.5 trillion in client assets. Even if 1% flows into Bitcoin ETFs, that's $45 billion. We're not there yet. Current adoption among their advisors is still single digits. But the infrastructure is live. The training is complete. Advisors are beginning to recommend allocation. This is a slow motion tsunami. Retail sees the Bitcoin price and thinks the move already happened. Institutions see 4.5 trillion in dry powder that hasn't been deployed yet. They're positioning ahead of that wave. Let's examine the Harvard endowment angle because it's fascinating. Harvard's endowment is $53 billion, one of the largest and most prestigious in the world, managed by Harvard Management Company. These are some of the smartest investors alive. They returned 10% annually over the past decade. They hold timber, farmland, private equity, hedge funds, real assets across every geography and asset class, and now Bitcoin ETF. The filing didn't disclose exact size, but confirmed the position exists. Why does Harvard matter? Because endowments move as a herd. If Harvard allocates to Bitcoin, Yale will look at it, Princeton will look at it, Stanford will look at it. Endowments benchmark against each other. Nobody wants to underperform peers. If Bitcoin rips higher and Harvard participated, but you didn't, you answer to the board. Career risk cuts both ways. The risk used to be owning Bitcoin and explaining a drawdown. Now the risk is not owning Bitcoin and explaining why you missed a generational asset. That shift in institutional psychology happened in 2025, quietly, without headlines. Here's another dimension. Sovereign wealth funds, Norway's government pension fund, $1.7 trillion, the largest sovereign fund in the world. They reported indirect Bitcoin exposure through equity stakes in Coinbase and MicroStrategy. Not direct Bitcoin holdings yet, but exposure nonetheless. Abu Dhabi Investment Authority, Qatar Investment Authority, Singapore's GIC. These entities manage trillions combined. They don't move fast, they move deliberately, but when they move, the market feels it. Right now they're in the research phase, hiring crypto specialists, meeting with custodians, running scenario analysis. The capital hasn't deployed yet, but the wheels are turning. Sovereign funds operate on 5 to 10-year investment horizons. They're building positions that will last decades. If Bitcoin is part of that portfolio mix, the implications are staggering. Let's talk on-chain data because it supports the institutional thesis. Exchange balances for Bitcoin dropped 1.5% in October. Ethereum dropped 18%. When coins leave exchanges, they're going into cold storage. Long-term holding. Institutional custodians like Coinbase Prime and Fidelity Digital Assets don't keep coins on exchanges. They store them offline. The decline in exchange balances correlates perfectly with the rise in ETF assets. The Bitcoin isn't disappearing. It's moving from speculative hot wallets into institutional cold storage. That's a supply shock in progress. Meanwhile, Bitcoin mining rewards continue decreasing due to the halving cycle. Miners produce roughly 450 coins per day. ETFs absorbed over 1,000 coins per day during peak inflow periods in 2025. Demand exceeded new supply by 2x. Basic economics. When demand outstrips supply for long enough, price adjusts upward. We saw this in 2020 and 2021 after the previous halving. History doesn't repeat, but it rhymes. The fear and greed index sitting at 24 extreme fear right now. Let me give you context. This index aggregates volatility, market momentum, social media sentiment, surveys, and Bitcoin dominance into one score. 0 is maximum fear, 100 is maximum greed. 24 means the market is terrified. Look at historical data. Every time this index dropped below 25 in the past 5 years, Bitcoin rallied within 3 months. March 2020, index hit 10, Bitcoin was 6,500. It went to 69,000. June 2022, index hit 8, Bitcoin was 18,000. It went to 110,000. The pattern is consistent. Maximum fear marks local bottoms, not every time, but most of the time. Right now, retail is scared. Reddit threads filled with should I sell posts, Twitter crypto accounts going dark, Google search interest for Bitcoin down 40% from the peak. Meanwhile, institutions are buying. They're buying your fear. This is the transfer of wealth from weak hands to strong hands in real time. Let's address the counter-arguments because ignoring them would be dishonest. Criticism number 1. Bitcoin has no intrinsic value. It doesn't produce cash flow. It's not a business. Fair point. Gold doesn't produce cash flow either. Neither do dollars or art or collectibles, yet people hold them. Why? Because value is subjective. Society agrees these things have worth. Bitcoin's value comes from scarcity, decentralization, censorship resistance, and network effects. You may not value those properties. Institutions apparently do. Criticism number 2. Governments will ban it. They've tried. China banned Bitcoin mining 6 times. It's still here. The United States could theoretically ban it, but the political cost is now too high. There are 52 million Bitcoin owners in the US. That's a voting bloc. There are Bitcoin ETFs traded on the New York Stock Exchange. There are senators who own Bitcoin. The regulatory ship has sailed. Criticism number 3. It's too volatile for serious portfolios. True. Bitcoin's annualized volatility is 60 to 80%. Stocks are 15 to 20. But volatility cuts both ways. High volatility means high potential returns. A 2% allocation to Bitcoin in a 60-40 stock bond portfolio historically improved risk-adjusted returns despite the volatility. Why? Because Bitcoin's correlation to traditional assets is low. It zigs when stocks zag. That's portfolio theory 101. Diversification reduces risk. Here's what nobody is talking about. JPMorgan accepting Bitcoin ETFs as collateral creates a feedback loop. Let me walk through the mechanics. A fund buys 100 million in IBIT shares. They pledge it as collateral at JPMorgan. They borrow 70 million cash against it. They use that 70 million to buy more IBIT shares. They pledge those as collateral. They borrow another 49 million. You see where this goes? Leverage on leverage. Institutions can now use Bitcoin to create synthetic liquidity while maintaining full upside exposure. This amplifies demand. It also amplifies risk if the market crashes. But here's the thing, JPMorgan wouldn't offer this product if they thought Bitcoin was going to zero. Banks don't accept worthless collateral. By offering Bitcoin as eligible collateral, JPMorgan is making a statement. Bitcoin is now in the same category as treasury bonds, investment-grade corporate debt, and blue-chip equities. That's a stamp of legitimacy that can't be undone. Other banks will follow. Bank of America, Wells Fargo, Citi. Once one major bank does it, the rest have to compete or lose business. This is how Bitcoin gets woven into the fabric of global finance, slowly, then suddenly. Let me give you a tactical playbook based on what we know. If you're new to Bitcoin and want to start building a position, here's a framework. Allocate 5 to 10% of your investable assets, not your net worth. Your investable liquid assets, money you can afford to see fluctuate. Split that into 12 equal parts. Buy 1 part per month for 12 months. This smooths out volatility. You'll buy some at highs, some at lows. Over time, you'll average into a reasonable entry. Don't try to time the bottom. Nobody can. Not even JPMorgan. They bought at 100,000. Bitcoin could go to 90 or even 80. They'll still be fine because their time horizon is 3 to 5 years. Match their behavior. If you already hold Bitcoin and you're worried about a drawdown, consider this. Set a mental stop loss, not a literal one because crypto markets are volatile and you'll get shaken out, but a price where you'll reevaluate. For most people, that's 40 to 50% below their entry. If Bitcoin falls, that far reassess. Has the institutional thesis changed? Are ETFs seeing outflows? Are regulations turning hostile? If yes, maybe reduce exposure. If no, the dip is probably a gift. History shows Bitcoin rebounds from major corrections stronger than before every single cycle. Here's an advanced strategy for larger portfolios. Replicate JPMorgan's approach. Buy Bitcoin spot or ETF shares. Then buy out-of-the-money put options 6 to 12 months out. You'll pay a premium for the puts. Think of it as insurance. If Bitcoin crashes, the puts gain value and offset your losses. If Bitcoin rips higher, the puts expire worthless, but your spot position makes money. You lose the premium, but you protected downside. This is called a protective put. It's finance 101, but almost no retail investors use it. Why? Because options seem complicated. They're not. Any brokerage that offers ETFs also offers options. Learn the basics, it's worth it. JPMorgan is using this exact strategy with 68 million in calls and 133 million in puts. You can do the same on a smaller scale. What happens if Bitcoin hits 170,000 like JPMorgan predicts? Let's run the math. Current price 104,000, target 170,000. That's 63% upside. 10,000 invested today becomes 16,300. Not life-changing for most people, but if you're holding a larger position, it adds up quickly. 100,000 becomes 163,000. Half a million becomes 815,000. The percentages scale linearly. But here's the bigger picture. If Bitcoin reaches 170,000, that likely means institutions deployed even more capital than they have now. It means sovereign funds entered. It means retail FOMO returned. It means the narrative shifted from Bitcoin is dead to Bitcoin is inevitable. That sets up the next leg higher. 170 isn't the end. It's a milestone. JPMorgan's analysts know this. Their public target is conservative. Privately, they're probably modeling scenarios much higher. Let me tell you what keeps me watching this space. this, the divergence between public perception and institutional reality. Public perception. Bitcoin is volatile, speculative, risky for degenerates and libertarians. Institutional reality. The largest banks in the world are buying hundreds of millions. The smartest endowments are allocating, sovereign funds are researching, regulators are creating frameworks instead of banning it. That gap between perception and reality is where alpha lives. When everyone knows an asset is good, the opportunity is gone. Right now, most people still think Bitcoin is a scam. That creates the opportunity. JPMorgan figured this out, Goldman figured it out, BlackRock figured it out. The question is, when will you? One more thing, the geopolitical angle. The US government holds over 200,000 Bitcoins seized from criminal cases. That's worth roughly $20 billion at current prices. There's been talk in Congress about creating a strategic Bitcoin reserve similar to the Strategic Petroleum Reserve. The idea is controversial, but it's being discussed. If the US government starts accumulating Bitcoin as a reserve asset, the signal to global markets would be deafening. Other countries would follow. Game theory kicks in. No country wants to be last. We saw this with gold. Every central bank holds gold. Not because they use it, because everyone else holds it. Bitcoin could follow the same path, maybe not, but the fact that it's even being debated shows how far we've come. Final thought, 8 years ago, Jamie Dimon called Bitcoin fraud. Today, his bank owns $343 million worth. Actions speak louder than words. Always have, always will. JPMorgan made a choice. They looked at the data, the trends, the regulatory environment, and decided Bitcoin belongs in institutional portfolios. You have the same information now. You've seen the filings, the analyst reports, the option strategy, the institutional accumulation, the on-chain metrics, the macro setup, the 3 scenarios. You know what JPMorgan knows. The only difference is they already acted. Have you? If this video gave you clarity, hit subscribe. Every quarter when new 13F filings drop, I'll break them down and show you what the smart money is doing. No hype, no speculation, just data. Next video. Cathie Wood lowered her Bitcoin target from 1.5 million to 1.2 million. Sounds bearish, right? Wrong. Her ARK funds bought more. I'll explain why in 3 days. Comment below. Are you buying this dip or waiting for lower prices? I want to know what you're thinking. See you in the next one.